Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. Today let us discuss about section 10 exemptions, which can be called as incomes which do not form part of total income. Exemptions from the incomes are all contained in various subsections and clauses of section 10. And in fact, most of these exemptions are covered under respective heads of incomes like salaries or capital gains, etc. But of course, there are certain exemptions which are generic exemptions as well. So let us discuss those type of exemptions in the current session. But prior to that, let us also note this point that agricultural income is something that is dealt separately anyway as a separate topic, and also section 10AA related to tax benefit for export oriented units in the special economic zones, that also is dealt separately. So those are as good as two different topics, so those will be dealt separately, whereas the other exemptions which are not covered by other heads of incomes, we will discuss them in the current session. Most of them are generic in nature. There is nothing much special to by heart things, but in general we can remember the essence of these exemptions and what is the logic behind those exemptions. If possible, remember the section numbers, otherwise you can just refer to section 10 in general. Starting with 10.1, which is again agricultural income, already known to us that it is exempt from tax according to section 10.1. 10.2 is the exemption of receipts by a member of HUF. Naturally, that is also exempt. Why? Because already HUF is an SSE. Whatever the income that the HUF has already earned was already taxed in the hands of the HUF as a separate SSE. Just a member of HUF receiving a share of that already taxed income cannot be taxed once again in the hands of the member. That is why this is exempt. So receipts by an individual as a member of HUF out of the income of the family or out of the income of the estate belonging to the family are exempt. For all of these things, are exempt, is exempt, has to be just added. These are all exempt. Shall not be taxable at all. If any limit is provided in the section, according to that limit, the exemption will be applicable. Otherwise, if nothing is mentioned, entire income is exempt from tax. Same logic applies to share of profits received by a partner from the partnership firm also. Logic is same. Because the partnership firm is already an SSE, it would have already paid tax, incurred tax liability on its own income, and after the tax also being deducted from the profit and loss account of the partnership firm, remaining profits are shared among the partners. It will not be fair to once again tax them in the hands of the partners. That is why share of profits received by a partner also are exempt in the hands of the partner. Naturally, the person who is a partner of a firm is separately assessed. As such, his share in the total income of the firm. So his share in the total income of the firm is exempt, and the firm itself is separately assessed. Because of that, share of profits received by a partner from a partnership firm is exempt in the hands of that individual partner. Naturally, when profit is exempt, loss also cannot be considered. Whether it is profits or losses, as a share of profit or loss from the partnership firm, it has to be ignored while computing the total income of the individual partner. Then 10.4 is about some of the non-residents, special exemption, particularly for non-residents. Those who are earning income by way of interest on any notified government securities and bonds, including income by way of premium on the redemption of such bonds, for them it is exempt. We don't need to know what are those notified bonds and securities. There will be some notified bonds and securities issued by the government. And if a non-resident subscribes to them and receives an interest on that, that will be exempt. Because those bonds already have this provision of as good as tax-free bonds issued to non-residents. And another important point, this can be one of the points in any question. In case of an individual who is a person resident outside India under FEMA, FEMA means Foreign Exchange Management Act. For our purposes, we can call him as non-resident as good as, or a person resident outside India. Any income by way of interest on the money that is standing to the credit of a non-resident external account in any bank in India is exempt. The non-resident Indians, popularly called NRIs, there is no definition for it, general usage. But definitely, most of the non-resident Indians will have some NRE account in any bank in India. That is called non-resident external account. Any interest in that account is completely exempt from tax. Of course, interest rates will be very less. That's a different story. But still, whatever the interest is there, earned in the non-resident external account will be exempt from tax under section 10(4). Though it is not given here, because the topic of NRE account has come, we should generally understand the kinds of accounts that non-residents can open in India. And we are talking about naturally NRIs who are opening bank accounts in India. There are broadly two types of accounts. There are so many deposit schemes, those are different. But as far as normal operatable bank accounts are concerned, which come with normal banking facilities of online transfer, ATM cards, etc. This account, what we are referring to here under section 10(4) is NRE account, that is non-resident external account. Some of the features of this account will be, the person can deposit money into this account only from outside India. This account is operated in India, in any bank in India, but deposit into this account can happen only from outside India. For example, imagine a non-resident Indian staying in America has a NRE account in India. He can send money to that NRE account, and maybe his family members can withdraw money from that account if he gives his ATM card to them. So it will have withdrawal facility anywhere in the world, but deposit cannot happen in India. Deposit should happen only from outside India. Those are NRE accounts. We don't need to know all that for tax purposes, but general knowledge wise, NRE account is different from NRO account. That is other type of account, that is non-resident operations account, operational account. That will be different. NRO account is also probably opened by the non-resident only, as the name itself indicates. But deposit can be made within India also. For example, a person who is the NRI staying in Canada has a house property in India. Maybe he has given it on rent. The tenants might deposit that rent every month into his NRO account. So that NRO account is operational account. Deposits can be made within India also. Deposits need not be made from outside India, because for that purpose anyway there is an NRE account. But the point here to note is, NRE account interest is exempt from tax under section 10(4), but not interest on NRO account. NRO account is as good as a normal savings bank account opened by any other person like resident in India. But only point is, the customer or the person who is opening that account is not a resident, so we are calling it as NRO account. No tax benefits are there for NRO account, but NRE account, whatever the interest or income that is earned on that NRE account is completely exempt from tax under section 10(4). So we can understand the purpose also. Money that is coming into NRE account, since it is coming from outside India, naturally that is the money that is received by the country in foreign currency. So that will increase our foreign currency reserves, naturally. But the money which is deposited into NRO account is coming within India. So that is our money only within our country only. So nothing special about it. So it is all as good as any other normal resident person's savings account. That is NRO account. NRO account has a lot of restrictions also. Nre account has restriction majorly about deposit. So if at all the question says non-resident operations account, I only remember non-resident, I don't remember external, you cannot say that. NRO account is different, Nre account is different. We are talking about non-resident external account, that is called Nre account. Interest on that is exempt from tax according to section 10(4). That is 10(4). Then 10(4)(b), not actually much required, but still, if any individual is there who is a citizen of India or a person of Indian origin, income from interest on national savings certificates issued by the government before 1/6/2002. We are talking about almost 18 years back. Then there was a provision like that. Most of them would have been already redeemed also, but still this provision is there, so just leave it there. Nothing much special about it, because it's a very outdated old national savings certificates we are talking about. Generally, NSC certificates will come with 6.5 to 7 years. Those days they used to come for 5 years, like that validity. Sometimes they could be renewed also. So that's a different story altogether. The point is, only those NSC interest on the national savings certificates issued before 1st June 2002, that interest is exempt under section 10(4)(b). Almost we can say it is as good as an outdated provision, so no need to separately worry about it. 10(5) is a separate discussion. Already we know it under the head of salaries. That is related to leave travel concession, section 10(5). This section number which are there in the heads of incomes, you have to remember. There you cannot say section 10. No. Other things, section 10(1), easy to remember, agricultural income. 10(2), 10(2)(a) sequence, same logic, HUF share and partnership share. 10(4), not that much required in the section number, but Nre account, just if you remember generally, interest on Nre account is exempt enough. 10(4)(b) not at all required. 10(5) you have to remember, and you should know that from the chapter and head of income of salaries. Then 10(6) can be asked as a separate theory question. It might not have much of relevance in the problems. Why? Naturally, when it is income that is exempt, what is there for us to calculate? There is nothing. So only just general knowledge. Okay, this guy's income is exempt, that guy's income is exempt. Who is that guy? What are the conditions? That's all. But a theory question separately can be asked. Income of a foreign national is exempt under certain circumstances. Explain those. 4 marks. Theory question can be asked. Then you have to write these 4 points. What are the situations where the foreign national's income is exempt? So in case of an individual, naturally, who is not a citizen of India, then only we can call him as a foreign national. Not a citizen of India. For them only section 10(6) applies. Will be exempt in the following cases. First one, in general, you can say diplomats' income. Who are those diplomats? Further description is given. Remuneration received by the person who is not a citizen of India as an official of an embassy, high commission, consulate, etc., and as a member of staff of any such official is also exempt. So foreign diplomats working in India normally will be considered to be residents for the purpose of residential status. Imagine an employee or an ambassador of other country working in India for a long time. Definitely he might have stayed more than 182 days during the previous year in India. Automatically he becomes resident. And if he has been there for service for longer time, he can be ordinary resident also. That means entire global income becomes taxable according to Income Tax Act. That would be embarrassing. Those people are working in India from their country's representation. So it will not be fair to tax them in India. So naturally we have to give them some exemption. That's what is given by section 10(6). Foreign diplomats. That is a general word you can remember, but specifically when you write it, officials of an embassy, high commission, or a consulate, or even member of staff, or member of the staff of such official is also exempt. So, for example, the secretary to foreign ambassador is a staff. He himself is not an embassy official, but still he is a staff of that ambassador, which means the salary of that person also would be exempt. So that is one of the exemptions given to foreign nationals who are foreign diplomats working in India naturally. If foreign diplomats are working everywhere else in the world, why should we give them exemption? Because they will not have any purview anyway under the Income Tax Act. But if they are working in India and they are residents, by chance, according to our residential status and tax incidence provisions, if their income, salary, and whatever other things that they received are taxable in India, that would not be fair. That is why their incomes are exempt. Simple. Same way, not only that, remuneration received by a trade commissioner or other official representative in India or a staff member of such official shall be exempt only if similar exemption is available in their country to the corresponding officials and staff in India. So if our staff get exemption from taxation of their country, their staff will get exemption in our country. It's like quid pro quo. We give you exemption only if you give us exemption. Of course, this is not for diplomats, by the way. Diplomats automatically exempt. This is second. Other category. These are called trade commissioners. These are not actually foreign diplomats, but really representing the foreign business as trade commissioners or other official representatives. They can have exemption only if their country extends exemption to our officials there. So that is another scenario. Of course, they cannot have any other business or profession or employment in India. That is another rule for claiming exemption. If they are doing any side business, in addition to being diplomats or trade commissioners, then this exemption will not be valid. So they cannot have any other business or profession or employment in India other than this. Then only exemption will be given to foreign diplomats and foreign trade commissioners. Foreign diplomats automatically get exemption. Foreign trade commissioners will get exemption only if our people will get exemption in their country. That's all. That is first category of foreign nationals whose incomes are exempt under section 10(6). Next, second category, remuneration received by the foreign national as an employee of a foreign enterprise. So he is an employee of a foreign enterprise, not Indian enterprise. But why are we giving exemption? Naturally, because he would have rendered some services during his stay in India. Then probably he would have stayed in India and rendered some services in India. And remember, residential status and tax incidence. Irrespective of the residential status of the SSC, if the services are rendered in India, automatically such incomes will be taxable because tax incidence will be attracted. It is deemed to accrue or arise in India. So once again, it will not be fair and proper to tax their incomes who are working as employees of foreign enterprises and maybe for a short period of time they are coming and visiting India and rendering their services in India. And if we are taxing them for that also, it would not be fair. With that logic, certain incomes received by them are exempt, of course, when the following conditions are fulfilled. What are the conditions? First condition is that the foreign enterprise is not engaged in any trade or business in India. So this is not for those people who are working for companies which are doing business in India. In other words, we can say generally, when we say it is not for trade or not for business means what? Mostly the charitable organizations. Lot of foreign charitable organizations work in India and their employees also visit to India. They do some services, render some services in India. And because of that, if we tax them, that will not be fair. So we are exempting that. Condition is that enterprise should not be engaged in any trade or business in India. And second condition is that the stay in India should not exceed 90 days in aggregate in the previous year. In aggregate, not continuous. Total period of stay during the previous year should not exceed 90 days. Are we saying that get out after 90 days? No, that is none of our business. If 90 days exceeded, then 10(6) exemption is not there. That's all. Remaining tax provisions will apply. That does not automatically mean that also the incomes are taxable. What are the incomes? What is the case? Those all things will be there. But 10.6 will not be possible to be claimed if the stay of that foreign national, who is an individual naturally, working in India and staying in India for a period of more than 90 days, then 10.6 exemption is not applicable, not given. Then another condition is that remuneration which is paid to this employee of the foreign enterprise, since it is exempt under section 10.6, the same cannot be claimed as the deduction from that employer's income. Whoever is that employer, who is that foreign enterprise, from their income, this amount of salary paid to the foreign national cannot be given as deduction while calculating the income of that employer. Why? Because logic is already that was given as exemption in the hands of the receiver of the income. Same amount is not given as a deduction for the payer of the income. So three conditions are there. If these three conditions are satisfied, foreign nationals who are employees of the foreign enterprise rendering some services in India will be having an exemption of 10.6 for the remuneration that they receive in that period. Conditions are: point number 1, that foreign enterprise should not be engaged in any trade or business in India. Point number 2, the stay of this individual should not exceed 90 days in aggregate during the previous year. Point number 3, the remuneration which is paid to this foreign national cannot be deducted by the employer while computing the employer's income. That is the condition to be fulfilled in order to claim 10.6 exemption for certain type of foreign nationals. This is second category. First category itself has two subcategories: diplomats and trade commissioners. Second category has normal people who are working for foreign enterprises in India. Subject to conditions, their remuneration also is exempt under section 10.6. Next, third point, remuneration for the services rendered by such individual in connection with employment on a foreign ship. Foreign ship. So somebody is employed in a foreign ship and the total stay in India does not exceed, let us say, in aggregate 90 days in the previous year. Then remuneration received by such individual also shall be exempt, irrespective of the residential status, naturally. When we say exempt, it is exempt. But only point is, this person should not be a citizen of India. We are talking about entire section 10.6 about non-citizens, foreign nationals. But in this case, this foreign national is working in a foreign ship and in the previous year his aggregate stay in India did not exceed 90 days. Then remuneration for services rendered by such individual shall be exempt. That's all. That was third category. Crew of a foreign ship, we can say. Condition: total stay cannot exceed 90 days. The same condition existed for second category also. Same condition exists for third category also. But second category has further conditions. Organization should not be involved in any trade or business, and employer cannot claim a deduction of the expenditure in the form of remuneration paid by him to this foreign national employee. So these are the different categories under which foreign nationals' incomes are exempt under section 10.6. And the last one is there within this: any remuneration received by the foreign national as an employee of a foreign government. Fourth category. So this person, our SSC, whoever is the foreign national, is the employee of foreign government. Of course, employee of foreign government, how can you tax him? Naturally, he would have visited India during the previous year. He would have been resident or whatever happened. Some income is taxable for him. But now we are exempting it. Subject to what condition? Here, when he is an employee of a foreign government, but why is he staying in India? In connection with his training in any undertaking owned by the government or a government company or a statutory corporation or a registered society wholly financed by the government. In other words, foreign government employees coming to India for training. Training not from private coaching centers. Training in undertakings owned by the governments or government companies or statutory corporations or any registered society wholly financed by the government. If the foreign government employees are coming for such a training in India, and maybe they are coming to learn some skills in India, and During this period, naturally, their employer, who is a foreign government, will pay them some stipend or some kind of expenses, and some money definitely they will receive as salary. But their stay in India is there here. So normally, according to residential status tax incidence, we say pay tax. That will be unfair. Those people came to India for learning, and these are not somebody just like that. Don't apply this logic to all foreign students and all. We are talking about employees of foreign government. They came to India for learning. That to training where they are getting training in government organizations. So whatever the income they receive during that period of stay in India is completely exempt. That's it. Remuneration, of course, will be exempt during that period of stay in India. So these are the 4 categories of people who are foreign nationals, but their incomes are not taxable in India, exempt in India. 1. Foreign diplomats and trade commissioners. 2. Employees of a foreign enterprise, subject to certain conditions. 3. Crew of a foreign ship, subject to condition of total period of stay not exceeding 90 days. 4. Foreign government employees coming to India for training in government organizations in India. That's it. That is section 10(6). Theory question separately can be asked on that. So those 4 points can be remembered for such a theory question. In general, it will be for 4 marks. 4 points, 4 marks. Perfect theory question possible. Then 10(6)(d), nothing to specially remember it. Any fees received by a non-resident other than a company from National Technical Research Organization. There is some organization, we don't need to know all about that. National Technical Research Organization is there in India naturally, and we are paying some fees to somebody, whoever it may be. Other than company, we pay some fees to some other foreign scientists or whoever it may be. All that income is exempt from tax. That's all, simple. So name to remember here is National Technical Research Organization. You see this name here in the paper. If any amount is paid by them, the other person's income is exempt. Of course, that other person should be a non-resident. Then 10(6)(d), such income or fees received by such person shall be exempt. So if you observe, right from section 10(4), we are talking about mostly non-residents. 10(4) also non-residents. 10(4)(b) also almost non-residents. 10(5) is not non-residents. That is leave salary. Leave travel concession. 10(6) is foreign nationals, not even Indian citizens. 10(6)(d) is not foreign nationals but non-resident. So most of these things are specially applicable to non-residents and foreign nationals. This series of exemptions is like that. Now 10(7) we already know. In the chapter of salaries, important section, you have to remember that with subsection. 10(7). Any allowance or perquisite paid or allowed outside India by the government to a citizen of India for rendering services outside India is exempt. So section 10(7) is something that is already there in the chapter of salaries. 10(5), leave travel concession was already there in the chapter of salaries. So what are the new things only? Those things you have to focus now in this session. Other things already we should be knowing them, but we can remind them once again. We can revise them once again, which are related to other heads of income, like 10(5), leave travel concession. 10(7) also, allowances or perquisites paid by Indian government to a citizen of India and amounts paid outside India for rendering services outside India are exempt. And there is a series of exemptions in the chapter of salaries, like gratuity section 10(10), commuted pension 10(10)(a), leave salary 10(10)(aa), retrenchment compensation 10(10)(b), voluntary retirement compensation 10(10)(c), tax on the non-monetary perquisites 10(10)(cc). Entire series is covered under the head of salaries already. So 10(5), 10(7), 10(10), 10(10)(a), 10(10)(aa), 10(10)(b), 10(10)(c), 10(10)(cc). 8 exemptions are already there within salaries only, and there will be some more exemptions also which will be there in the salaries. That is why the salaries chapter has most of the exemptions covered under section 10. These are all the things to be remembered very well. Provisions are there in the head of salaries. Tax on non-monetary perquisites is an important point, 10(10)(cc). That is exempt in the hands of the employee and this amount is not deductible from the employer as an expenditure. So that also, the other side also you should remember. Same way, voluntary retirement compensation is exempt under 1010C for employee, whereas for employer it is not deductible in one shot, it is deductible in 5 equal installments. Like that, one side employee is there, other side employer, what happens to them, that also to be known. It has nothing to do with section 10, but the whole picture has to be understood. Gratuity, for example, pension or leave salary, any kind of compensations that are payable to the employees are deductible for the employer only on payment basis. If there is only provision created, that is not deductible for the employer. Whereas voluntary retirement compensation is deductible in 5 equal installments on payment basis. Tax on non-monetary perquisites for employer is not at all deductible. These are the other sides of this. Exemptions in the hands of employees. Whereas what happens to employer also should be known to us. Then, coming to section 1010BB, simple just general thing, naturally, humanitarian type of exemptions. Compensation received by the victims of Bhopal gas leak disaster. So in the city of Bhopal, long back, a gas leak happened, dangerous gas, chemical gas was leaked from a factory called Union Carbide, and I'm not sure about the exact number, but hundreds of people have died and thousands of people, even lakhs of people actually got sick. Even recently also, still the I would say the ill effects of that disaster are visible now in the form of lesser immunity for those people in the case of COVID as well. So that was one of the worst possible industrial accidents, we can say, in the history of India, and definitely very tragic incident. And government naturally would have awarded some compensation. That company also would have paid some compensation to the victims. If that also is taxable, that will be completely inhumane. So naturally that is exempt. 1010BB exempts all the compensation received by the victims of Bhopal gas leak disaster. So why only Bhopal? Let us have it for everybody. So that is 1010BC. Any amount received or receivable from the central government or state government or local authority by an individual or his legal heir by way of compensation on account of any disaster. So lot of times we see accidents happen, fire accidents happen, industrial accidents happen, natural calamities happen. Government declares compensation. Okay, this government has given 1 crore, that government has given 5 lakhs, 10 lakhs, like that they give. Money is huge actually sometimes. And that money is definitely taxable, normally speaking. But that is once again inhuman, unfair. So exemption is given under 1010BC for any money given as compensation by central government or state government or local authority. All the 3 governments, if they give any compensation to the victims, that compensation shall be exempt. Of course, if the person has claimed any deduction for any loss or damage caused, to that extent compensation shall be taxable. Imagine if a businessman has lost all his stock and total loss was 2 lakhs, and the government, let us say, because of whatever reasons, gave a compensation of 2 lakhs. But already, let us say this person has claimed a deduction under PGBP because it's a trading loss. Then this 2 lakhs becomes taxable. So if at all, whatever the amount of claim happened in the form of loss as a deduction from the income, to that extent the compensation shall be taxable, and if such claim of loss is not made under this act, then entire compensation shall be exempt. That is 1010BC. So 1010BB is about Bhopal gas leak disaster compensation. 1010BC is about any disaster, any natural calamity or other things where the government, all the 3 types of governments, give compensation to the victims. That is 1010BC. Then very important section again in this entire series of exemptions is 1010D. You have to remember this section also. It is very, very important because it is related to individual and in general there will be some amount which will be given as part of any bigger question of computation of total income of individuals. Of course, it is exempt. So what is the big deal to remember here? The main point is this exemption is subject to conditions. That is why we have to remember those conditions. What is this exemption? First of all, is 1010D. Any sum received under a life insurance policy, including the sum allocated by way of bonus on such policy, is exempt. So if a life insurance policy got matured or it has completely, let us say, claimed, it has been claimed, then any such sum received under such a policy, life insurance policy, including bonus on such policy, shall be exempt under section 1010D. Will this exemption apply to the keyman insurance policy? No, this exemption does not apply to keyman insurance policy. We know that keyman insurance policy is fully taxable, but of course taxable in three different cases. Taxable in the hands of employee if he receives it, taxable in the hands of employer if he receives it, taxable in the hands of the other persons if other persons receive it, is taxable under income from other sources. So employee will be taxable under salaries head, employer will be taxable under PGBP head, any other person will be taxable under income from other sources head. If any proceeds are received under keyman insurance policy, nothing is exempt for the proceeds related to keyman insurance policy. 1010D is not applicable to that. Other than that, any life insurance policy related proceeds received by any person shall be exempt. Of course, that is the third point also. Amount received on maturity of a keyman insurance policy, including bonus or thereon, is taxable, not exempt. But now the main point of 1010D is the condition. Condition is here. The same condition will be repeated in discussion of ATC also later in the chapter of deductions. But 1010D and ATC are related with each other, related to life insurance policy. That is why they become important. So exemption available under 1010D, exemption we are talking means some receipt is there. Exemption is different, deduction is different. ATC deduction comes when somebody contributes some amount to a life insurance policy when he pays the premium. That's not an inflow, that's an outflow. For that, a deduction is given under ATC. We'll come to that later. But here 1010D is for exemption. Exemption will be means automatically exemption can be given for an income only. Exemption cannot be given for expenditure and all or investment and all. It is exemption. So it is income that is exempt. Income in the form of what? Inflow. In the form of amount received in relation to a life insurance policy. It shall be allowed as exemption only when the conditions are satisfied, and if it is not satisfied, 1010D exemption shall not be allowed if at all the insurance policy issued on or after the first day of April 2012 in respect of which the premium payable in any of the years during the term of the policy exceeds 10% of the actual capital sum assured. That is the condition. That means for the policies issued on or after 1/4/2012, the maximum premium, annual premium, cannot exceed 10% of the capital sum assured. Let us say the policy is taken for 1 lakh rupees, premium paid 15,000 rupees per annum. No exemption is allowed when such policy matures. Of course, no deduction is also allowed under ATC for the such payment of premium. That can be looked at later. So these two are linked with each other, 1010D and ATC. Both are completely different contexts, but conditions are same. One is paying the premium and claiming deduction, that was ATC. Now receiving some amount as a maturity amount and claiming exemption under 1010D. So when a policy issued on or after 1/4/2012 had a premium of more than 10% of the sum assured, then exemption under 1010D shall not be applied. Of course, what if the policy was issued on or before 31st March 2012? Then the premium should not exceed 20% of the actual capital sum assured. So prior to 1/4/2012, the premium could be 20% of the sum assured. Sum assured is generally called as policy amount. So if 10 lakhs rupees is the policy amount, if the annual premium was 2 lakhs, earlier it was okay. Earlier means when, if the policy was issued before 1/4/2012. If the policy was issued on or after 1/4/2012, then the capital sum assured will be there, and on that 10% only can be the maximum premium. If the premium exceeds 10% of the capital sum assured, then deduction under 80C will not be available. Exemption under 1010D also will not be available. But of course, prior to this 1st of April 2012, 15% is allowed for a disabled person after this 1/4/2012. Prior to 1/4/2012, 20% is there for everybody. But after 1/4/2012, normally the premium amount cannot exceed 10% of the capital sum assured. But if the person is a disabled person, it is okay up to 15%. So these are the 3 percentages you should remember, and the dates you should remember. Main date here is 1/4/2012. After that, how much can be the percentage of premium to the sum assured? 10% normally, for 15% for disabled persons. Prior to 1/4/2012, the ratio of premium to the sum assured can be maximum 20%. That is the condition. If these conditions are satisfied, then amount received by way of proceeds from life insurance policy, maturity, etc., including the sum allocated by way of bonus on such policy, shall be exempt. But here also there is one more point. This can be like kind of MCQ type question. If any sum received under the policy is happening on the death of the person, then it shall continue to be exempt. So 1010D conditions 10%, 15%, 20%, all these things are not applicable if the sum received is occurred in relation to the death of that person. Of course, on the death of the person means person will not receive it. Some of his relatives will receive it. But that will be exempt if such sum received under life insurance policy is related to death of that policy holder. For death, there is no taxability. For others, also it is exempt. But only condition is the sum assured and the policy amount, we have to check. Policy amount normally cannot exceed 10% of sum assured. But if the policy was issued after 1/4/2012, but if the person is disabled, then it is 15%. If the policy is issued before 1/4/2012, then the percentage is 20%. If the amount is received because of death of the insured, then no problem. Entire amount is exempt. That's all. Next. The value of any premium agreed to be returned or of any benefit by way of bonus or otherwise over and above the sum actually assured shall not be taken into account for the purpose of calculating the actual capital sum assured under this clause. What is this word actual capital sum assured means? Should it include bonus? No. While calculating that, we should not include bonus. That is only for calculation, condition checking. It has nothing to do with taxability. Exemption is there for bonus also, but for calculating capital sum assured, bonus assured also should not be included. If at all there is any other premium reduction happens at the end of the policy, any such benefits shall not be taken into account. So original capital sum assured, whatever is the insured amount, shall be taken into consideration for calculating this 10%, 15% or 20%. That's all. That is for exemption in relation to proceeds from life insurance policy exempt under section 1010D, subject to conditions about the amount of premium as a percentage of sum assured. That is the only condition. And key man insurance policy is not covered by 1010D. That is 1010D. Now, once again, so many exemptions under the head of salaries. 1011, contribution to statutory provident fund and amount received from statutory provident fund exempt. Amount received from recognized provident fund exempt, and contribution to the recognized provident fund also taxable only related to the employer. Up to 12% of salary it is not taxable. Beyond that only it is taxable. But amount received from recognized provident fund at the end of the period is exempt. Amount received from statutory provident fund under section 1011 is also exempt. Amount received from approved superannuation fund is also exempt, approved. And HRA is exempt under section 1013A. And so many allowances are there under section 1014, which are also exempt, according to those sections which are already covered under the head of salaries. Now, some more exemptions. This is just a name, you have to remember that. Sukanya Samruddhi Account. These are some of the general names, you have to remember them. Nothing to by heart them, but just you should be able to identify. When you see this, you should think about, oh, some exemption is there for this. Section number, if you remember or not, it's okay, it's up to you. 1011A says that amount received under Sukanya Samruddhi account is exempt, whether it is interest also, withdrawals also. Withdrawals anyway will be exempt because it is our money only, we are getting it back. But interest on Sukanya Samruddhi account is exempt. So this is a kind of bank account, like a normal bank account only, where any person in India can open in the name of their daughters, in the name of the girl child. And they can keep on depositing money into that Sukanya Samruddhi account, which can be used later for their education, etc. That's a savings account, nothing special about it. Yeah, name wise, it is specially made for girls, opened by generally their parents. So that is Sukanya Samruddhi account. But interest on that account is exempt. So what is the purpose here? To attract more investments or more savings in the name of girl child. That's it. That is one of the exemptions to a particular type of bank account called Sukanya Samruddhi account. Next, National Pension Scheme. Any receipt from National Pension Scheme is exempt under section 1012A. We are talking about receipts only. Contribution to National Pension Scheme, whether it is eligible for ATC or not, that is again a different discussion. That will be about deductions. That will be chapter 6A deductions. That is when the amount is contributed. Now we are not talking about that. Even when we look at all these things, 1011, 1012, 1013, we are looking at receipts, not payments. Exemption is given under 1011, 1012, 1013 about receipts from statutory provident fund or public provident fund or recognized provident fund or approved superannuation fund. So that is the exemption concept itself. So when we look at National Pension Scheme also, it is the receipts that will be exempt. So any lump sum payment received, lump sum, by the nominees of a deceased SSC under the National Pension Scheme is fully exempt. If at all, nominees of any deceased person have received amount from the National Pension Scheme, that is fully exempt. Of course, in case the SSC himself is opting out of the scheme, then 40% of the withdrawal is only exempt. Only 40% of the withdrawal is exempt if SSC is opting out of this scheme. Of course, other side is, if the SSC withdraws partially, then exemption is given only if the withdrawal does not exceed 25% of his total contribution to NPS. So that is the exemption given. But once again, point is, this is a kind of social security, National Pension Scheme. Normally, the SSCs themselves will contribute their own money, but sometimes employers also contribute their own money. They are withdrawing, that also is not exempt, is what is mentioned here, which can be against the normal rules of justice. But the point is, the government doesn't want the people to withdraw the money unnecessarily. They want this to be there. It has to be there for their social security at a later stage. So what is the maximum amount of withdrawal that they can do? Is 25% of his total contribution to NPS. He can withdraw, and then to that extent, that withdrawal is exempt. If at all more than that is withdrawn, that becomes taxable. So a lot of controversial things are there around this taxability of withdrawal. We don't know whether they will continue or not, but as of now, in general, you can say receipts from National Pension Scheme are exempt in case of deceased SSC, and in case the SSC is opting out of the scheme, then 40% of the withdrawal is exempt. And SSC is not opting out, he is only withdrawing partially. He is continuing in the scheme, but he just wants to withdraw. Then 25% only is exempt. Up to 25% only it is exempt. That means if the withdrawal is up to 25%, so then only the exemption of section 1012A applies. That is receipts from National Pension Scheme, very special situation for few people who have contributed to this NPS. Next, important section now, which is useful for problems, is 1015. This section you can remember because there will be definitely one point in the entire paper somewhere you can apply this. So such sections you have to remember. So interest on certain securities, bonds, saving certificates and other certificates issued by the government is exempt under the various provisions of section 1015. So many are there actually. You don't have to go through all of them. Some of them which can be just remembered in a nutshell are: one is interest on some notified bonds and certificates. What are those notified bonds? We don't need to know. But government tax-free bonds, if the government says, that means it is tax-free. Income, interest coming from on those bonds will be exempt. But what is important for us to be remembered more than everything is this. That is point number 2. Interest on the post office savings bank account is exempt up to 3,500 rupees for individual accounts and 7,000 rupees for joint accounts. This number you have to remember. Why? Because it can be there appearing in the problems anywhere. But point to be noted once again, it will be taxable under the head of income from other sources normally. Imagine if there is a post office savings bank interest of 10,000, in that 3,500 only will be exempt. So remaining 6,500 will be taxable. It will be included in the income from other sources and the gross total income of the SSC. It's a different story. After that, savings bank account interest is exempt or deductible under 80 TTA separately. That is different. Don't mix that. So interest on savings bank account including post office is deductible under 80 TTA up to 10,000 rupees or up to 50,000 rupees for senior citizens under 80 TTB. That is different. That is deduction from gross total income. This is exemption applicable for everybody. Anybody can get this exemption. How much? Up to 3,500 rupees for individual account and 7,000 rupees for joint accounts. Main point here to remember where students do mistake is this is only applicable for post office savings bank account, Baba. It is not for other State Bank of India, National Bank or other Indian Bank or other banks savings account. No, it is not bank savings account. It is post office savings bank account. Post office only, not any other bank, whatever that bank may be. So exemption of 3,500 should be given only if the question says post office savings bank account interest. Otherwise, no. How much exemption? 3,500 or 7,000 as the case may be. This is something you have to remember for section 1015, which will be there in the exam in any of the points somewhere in the questions. Remaining things are general things. You have to just broadly remember them. Gold deposit bonds, RBI relief bonds, gold monetization bonds, some other notified bonds issued by local authority or a state pooled finance entity. What are all those things? We don't need to know the list of them. There will be a huge list of all those things which are not taxable. Interest on those things, those will be there for real purposes. For examination purposes, if you remember, generally notified, RBI relief, gold monetization, those are enough. But exam purposes, calculation purposes, problems wise, savings bank account interest exempt up to 3,500 or 7,000 should be remembered. For that purpose, you have to remember section number 1015 also. That's an important section, particularly for that post office interest on savings bank account of post office. Then other generic things, scholarships. Scholarships granted to meet the cost of education are exempt in the hands of the recipient, irrespective of the amount or source of scholarship. Scholarships for meeting the cost of education are exempt in the hands of recipient. That's it. Income of MPs and MLAs under section 1017 is exempt. Of course, not the remuneration. Remuneration is taxable. That is taxable in the head of income from other sources. But what is an exempt? Daily allowance that they receive or some other constituency allowance, let us say, that is exempt. So any other constituency, all constituency allowances, those are all exempt for MPs and MLAs. Daily allowance generally will be given for attending the parliament or assembly. Constituency allowance is given for spending it on constitution actually. So that should be exempt. Whether they spend or not is a different story. But that is exempt under section 1017. So daily allowance, constituency allowance are exempt for MPs, MLAs. Remuneration is taxable under income from other sources. And again, generic thing, awards and rewards, anything actually. Generally, you can broadly have, of course, not Filmfare Award and private awards. We are talking government awards. Awards and rewards, any payment made in cash as any award instituted in public interest by central government or state government or any other body and approved by the central government, Padma Shri, Padma Bhushan, Padma Vibhushan, like that. Many awards will be given, and along with that, some money also will be given, some 1,50,000, whatever. But that amount, whatever is given, is exempt from tax. And not only that, Any other reward also. So award also is exempt. Reward also is exempt. Of course, when that is given by central government or state government, as may be approved by central government in public interest. For example, C.V. Raman Award for experimental research, national awards for films and all, they get national awards, no? So those things are all exempt. Amount received by those awardees are exempt. That is under section 1017A. Nothing special. This is also normally understandable. Any income received by way of pension or family pension, particularly related to the people who served central government or state government and who are awarded Paramveer Chakra or Mahavir Chakra or Veer Chakra, which are generally called as gallantry awards. Gallantry awards means for their bravery in the services, particularly police and more particularly military personnel will get these awards. A lot of times it so happens that person himself would have died in the war, and their family members might receive family pension. Should that also be taxable? These are the brave people who have sacrificed their lives for the country, and their family should pay tax on the family pension they are receiving. How bad that would be. That is why that is not going to happen. Definitely they should get exemption. They got exemption. So the pension or family pension received by these people themselves or by their family members also shall be exempt. Who are those people who have received these gallantry awards? Like, these are only examples, like Veer Chakra, Mahavir Chakra, Paramveer Chakra, Kirti Chakra, etc., etc. And family pension received by their family members also is exempt. Now, another section is there for particularly the family members of soldiers. Though they are not Mahavir Chakras, Paramveer Chakras, but still, any family pension received by the widow or children or nominated heirs of members of armed forces of the central government. In this case, naturally only central government will come. We are not talking police. So central government armed forces, including paramilitary forces. Paramilitary forces like CRPF, CASF, BSF, etc. So including them, any armed forces of central government's family members receiving a family pension, that shall be fully exempt. Conditions apply. If the death of such member has occurred in the course of operational duties. Operational duties means maybe while combating the enemies, they would have died in the fight. Then the family pension received by those families of the brave soldiers will be exempt. Of course, a lot of conditions are also there. Not only conditions, but still can't help it. Law is law. In general, we can understand most of the people's family pension, particularly the soldiers and armed personnel's wives and children, if they are receiving the family pension, that would be exempt in general, we can say. And those who received gallantry awards or their families also will have exemption applicable. So normal things, these are all generic things. See, scholarships exempt, Bhopal gas leak, normal, no? Bhopal gas leak victims should be exempt or not? Of course it should be. So like that, these are all generic things. Same way, any compensation received for any disaster, generic thing. So particular things you have to very specifically remember. 1010D, special thing. You have to remember that. Particularly you have to remember. 10.6, theory question can be asked on that. So what are general things? You don't need to separately spend more time on them, which are any general knowledge type. But which are particular, like 1010D, like 1015, those have to be focused upon. Other things are normal. Sukanya Samruddhi account exempt, scholarships exempt, daily allowance, constituency allowance of MPs and MLAs exempt, awards, rewards exempt, gallantry award winners pension and family pension exempt, and family pension of armed forces family members also is exempt. That's it. These are all various generic things. And some other generic things are there, mostly like, social welfare and humanitarian grounds. These are all mostly in that sense. Those are all exempt. Particularly certain things related to the scheduled tribes or caste incomes, not for everybody throughout India. Any income of a member of a scheduled tribe residing in any area specified in this behalf. Of course, there are so many areas which are specified: Arunachal Pradesh, Manipur, Mizoram, Nagaland, Tripura, Ladakh region in the state of Jammu and Kashmir. Certain areas are prescribed like that. If any member of the scheduled tribe is having some income, and if it is earned from any source, in that area, or it is by way of a dividend or interest on securities, then that is exempt, completely exempt. So if a person who is a member of a scheduled tribe residing in those specified areas, mostly the northeastern states and the Ladakh region of Jammu and Kashmir, if that person is earning income there, entire income is exempt. Of course, not for all the people in the northeast and Jammu and Kashmir. We are talking about member of scheduled tribes, ST members or candidates who have income in those particular states, specified states, and they earned income there. Or even if they earned income by way of dividend also or interest on securities also, still that will be exempt. That is another special exemption for section under section 1026. Particularly the northeastern states and Ladakh region of Jammu and Kashmir, to which this exemption is granted, that too for members of scheduled castes or scheduled tribes. Then section 1026 AAA is also there for particularly the individuals who are Sikkimis. Naturally, those means those people who are belonging to the state of Sikkim. So individuals who are belonging to the state of Sikkim, if any income is arising or accruing to them from any source within the state of Sikkim or by way of dividend or interest, same logic. If they are earning income within Sikkim, any individual, here there is no restriction on caste or tribe, any Sikkimis person, entire income whatever they earn within the state of Sikkim will be exempt. Of course, not that outsiders are coming there and earning income in Sikkim, that is exempt. No, that person should be belonging to Sikkim. So, being a Sikkimis, if an individual earns income within the state of Sikkim, or even if he earns income anywhere else in India also by way of dividend or interest on securities, entire such amount is exempt from tax. So that's a big exemption given to the individuals belonging to the state of Sikkim. Of course, there are some other situations because of which some exceptions are given here. Exemption shall not apply to a Sikkimis woman who, on or after 1st April 2008, marries an individual who is not a Sikkimis. So, probably some people would have misused this exemption by taking, probably entering into a marriage with a Sikkimis woman and showing incomes in their hands and claiming exemption. Probably, we don't know all that. Maybe yes, maybe some people will be always there, crooked people will be always there, who will try to use the loopholes in the law. Maybe because of that, this amendment has happened. If at all a Sikkimis woman marries an individual who is not a Sikkimis, then that Sikkimis woman cannot get this exemption. It is definitely very gender biased provision. Can't help it. Law is law. Whatever is there, it is there. So what happens if a Sikkimis man marries a non-Sikkimis woman? No problem. Exemption will continue. But if a Sikkimis woman marries a non-Sikkimis man, then exemption will not be applicable to that Sikkimis woman. That's it. Law is law. We can't have any. We can have opinion on that, but we can't change that. That's what it is. So that is about section 1026 AAA. One time it was asked for 2 marks. What are the benefits granted to an individual belonging to the state of Sikkim? Simple 2 marks question. Exactly how to write this. And if you remember section number, you write it, otherwise no. Easy to remember, AAA. 26 AAA under section 10. So, income earned by an individual belonging to the state of Sikkim from any source within the state of Sikkim or by way of interest or dividend is exempt. Only condition here is for a Sikkimis woman who marries a non-Sikkimis person on or after 1/4/2008, this exemption is not applicable. That's all. Now, there are 2 things which are like general things once again. You can just remember them. Subsidies given for growing and manufacturing tea in India. And subsidy received by that person from tea board for the replantation or replacement of tea bushes or for regeneration or consolidation of areas used for cultivation. Subsidy received by a person who is growing and manufacturing tea in India from tea board is exempt. Why the tea board will give just like that any subsidy? It will give for replantation or replacement of the tea bushes. If it gives, such subsidy is exempt in the hands of the growers and manufacturers of tea. Then 1031 says why only tea? So we extend it to other things also. Rubber, coffee, cardamom or other commodities, coir board, like that. So coir, so many boards are there in India. We have rubber board, coffee board, cardamom board, any other board where subsidy is received from that concerned board under any scheme for replantation or replacement of plants or for regeneration or consolidation of areas under cultivation, it shall be exempt. So simply speaking, 1030 and 1031 both are related to those SSCs who are in general agricultural activity, but still they might have certain subsidy that is received from their respective boards, from tea board, coffee board, rubber board, cardamom board or coir board, like that. If they received any subsidy from those respective government departments, that subsidy shall be exempt. That's all. Now 1032 is an important one to remember, and of course we will apply it later when we deal with clubbing provisions. Extensively we have to apply 1032 in the chapter of clubbing. Wherever the SSC has his minor child's income also to be included in his income according to clubbing provisions, then exemption is given up to 1500 rupees in respect of each such minor child. Once again, 1500 rupees per annum only, naturally. If nothing is mentioned, always per annum. So for each such minor child's income clubbed in the hands of the SSC, 1500 rupees shall be given as exemption under section 1032. That is clubbing related exemption. That 1034, already we know, exemption is granted for the dividends received from domestic company. Of course, only up to 10 lakhs rupees. Then 1034A also, we discussed in the chapter of capital gains. If at all unlisted companies buy back the shares, or even now change it to even listed companies, then it will be taxable in the hands of the company. So naturally what happens in the hands of shareholder, that will be exempt. When it is already taxed in the hands of the company, then for the shareholder that same should be exempt under section 1034A. 1035, this also should be remembered. Income from the units of UTI, Unit Trust of India, or other specified mutual funds are exempt. So units of UTI or specified mutual funds also, income received from them is exempt. These are all various things under section 10 as a series of exemptions. Now 1037 is already known, which is related to capital gains. Capital gains arising on compulsory acquisition of agricultural land, exempt under section 1037. 1037A is also an extension of that, but that is only for whom? Capital gains from land pooling in the state of AP, Andhra Pradesh state, Amaravati development, etc., etc. Whatever happened long back, in the form of land pooling, the government has collected land from the farmers of Amaravati around area, and capital gains arising to those farmers from such land pooling is exempt under section 1037A. And 1043 says amount received in a transaction of reverse mortgage is also exempt. We will discuss these two things separately, 1037A and 1043, because directly they don't have much of relevance in the chapter of capital gains, though they are covered in the capital gains, but they can be asked as separate questions, as a small short note or a case-based question can be asked. Reverse mortgage is a very popular question. Many times it is asked as a short notes. So we'll discuss them separately. But 1037 is already known. If the compulsory acquisition of agricultural land happens, naturally urban agricultural land, because anywhere rural agricultural land is not a capital asset, so no need to give any exemption to that. If urban agricultural land also is compulsorily acquired, then compensation received from that or capital gains arising from that shall be exempt under section 1037. Then 1045, naturally our babus have given exemptions to their gurus, at least they showed that. Respect, any allowances or perquisites paid to the chairman or a retired chairman or a member or a retired member of the Union Public Service Commission is exempt from tax. Union Public Service Commission, UPSC, is the main body for conducting and selecting the administrators in India, IAS, IPS, IRS, etc. All these people are selected by UPSC. So UPSC is that premier body for selecting executive personnel in India. So the members of them, chairman of them, retired members and retired chairmen also. Their allowances, and not everything, by the way, salaries and all not exempt. Notified allowances or perquisites to them shall be exempt. So that was 1045. Like this, many exemptions are there, and some more exemptions are there, like petrol money and all that. Those are all not required. I mean, those are two international level situations. Simply for a normal individual, for a basic SSC that we generally encounter in the exams, these are already more than enough. But even within this also, particular exemptions definitely you should remember, other than those which are already covered in the chapter of salaries or other capital gains. 10.1 everybody remembers, so 10.2, 10.2a is logical. 10.4 Nre account you should remember, 10.4 be not required. 10.6 for a theory question you can remember separately. 10.6d is just remember this name, National Technical Research Organization, that is enough. 10.7 and etc. we know already in salaries. Bhopal gas leak is natural disasters, and simple, nothing to specially remember. 10.10d you have to separately focus and remember that. And other provisions in salaries are anyway supposed to be remembered. Sukanya Samriddhi account, remember that name, that is enough. National pension scheme, remember that name, that is enough. 10.15 you have to remember, very important, particularly in the problems. Particularly post office savings bank account in trust, exempt up to 3,500 or 7,000. Normally 3,500 only. Joint accounts is exceptional. Normally 3,500 is the amount of exemption maximum in respect of interest received from post office savings bank accounts under section 10.15. That should be remembered. Scholarships normal, nothing special. Incomes of MPs and MLAs, particularly for daily allowance or constituency allowance. General things, awards, rewards, general thing. Gallantry awards, soldiers, general thing, nothing special to remember. Sikkim exemption was asked earlier, so maybe that can be remembered specially. But 1026 especially again need not be remembered, and so many changes keep on happening to that list of states and regions also, so we don't have to too much worry about 1026. 1026 AAA, yes, it was asked earlier as one question. Subsidy received from T-board, etc., are naturally exempt. So 1030, 1031 in general you can remember, nothing special. 32 you have to remember, that we will use in the chapter of clubbing also anyway. 34, 1034 we have to remember, and we have to also understand the exemption limit under section 115O is only 10 lakhs. So anything above 10 lakhs rupees is taxable under section 115O. 1034 has to be remembered. 1034A special scenario, it can be remembered for the purpose of capital gains chapter, which is already discussed in capital gains anyway. And 1035 income from mutual funds, specified mutual funds, not any mutual fund, or UTI, which is a government type of organization, so that is exempt. 1037 is related to capital gains, that is compensation on compulsory acquisition of urban agricultural land. Reverse mortgage and what about this Amravati story, we will discuss that now. 1045 we have to just understand, nothing special to remember. UPSC, all things related to them, allowances and perquisites are exempt. So let us just quickly go through these 2 points. What is a reverse mortgage, and what is the story of this land pooling thing in AP? Before going to that land pooling thing, reverse mortgage is a very important theory question, separate question can be asked. What is this transaction? What is mortgage normally? Mortgage means I have an asset, I will keep it as a security in the bank, and I will take a loan. That's what we call it as mortgage normally. But this is reverse mortgage. And this is only given for the benefit of senior citizens. Means the SSC will be at least 60 years old. Otherwise, there is no reverse mortgage. But what this senior citizen guy will do, he already owns a residential house property, of course. Mostly, we don't need to know the story completely, but you can imagine they don't have any much of other incomes like pension and all. They are not receiving, their kids are not looking after them. Probably they are not having any regular income, but they have a own house at least. So what they should do to eat? This old couple probably staying in own home, own house, but no income, no support. Nobody is supporting them. Probably. So this is all story, not the transaction. Transaction comes to support them. Reverse mortgage is a transaction which comes to support them. So these are the people who are senior citizens and who own a residential house property. So what they do is, in order to supplement their existing income, if any, they can mortgage their house property with a scheduled bank. Of course, even a housing finance company, in return for a lump sum amount or for a regular monthly or quarterly annual income. So what they are doing is, their house they are not vacating. They are not selling also. They are only mortgaging it in the bank. They are giving their house documents to the bank, and immediately they may receive a lump sum amount also, but most often than not, they will be receiving some regular monthly income. So they mortgaged the house, and monthly they are getting income. Is that income? Actually not. It's a kind of loan only, disbursed monthly. So, but why it is called reverse mortgage? In the mortgage, you pay EMIs to the bank. But in this reverse mortgage, bank is giving you EMIs. You means the senior citizen. So the SSE, whoever is a senior citizen, he would have already had a residential house property and he must be a senior citizen, and he has mortgaged his house property with the bank. This facility is there with many of the nationalized and scheduled banks. And that bank in turn will give either a lump sum amount of loan or gives a monthly or regular income, quarterly or annual income. So what happens with the senior citizen? Does he vacate the house? No. He can continue to live in the house. But at the same time, he'll also have some regular income. Though it is not income, he has money. Money is important. One way he has monetized his own house. Instead of selling it, what he is doing is mortgaging with a bank. Bank is giving him money monthly. And they don't have to worry about payback of the loan. Why? Because they're already senior citizens. Sooner or later, they'll go. So they don't have to worry about the payback of the loan and all. Their home itself is a security against which this loan is given. Just they have to keep on receiving money and enjoy that money. That's all. So this is a kind of social security for those people who own a residential house property in India. Of course, those people who have no sentimental attachment to that house property, who will be very less. And these kind of schemes, though they are useful, very less popular because of, once again, sentimental value that our people have with their house properties than others. So the problem is, it's not a good hit. But if you look at the scheme itself, it is a fantastic scheme. The old people have support, and they don't have to sell the property and go somewhere. They are staying in their own house. At least that sentimental feeling is there. They are not vacating their own house. They would have worked hard to construct this house. They would have had dreams about this house, and they don't need to vacate that house. They'll continue to stay in that house. Still, they have money coming from the bank every month, which is basically a loan disbursed in installments, you can say. So they don't have to bother about incomes other than that. If they have less pension or don't have other incomes after that age, they can happily enjoy this money by mortgaging their house property with the bank. And they don't have any botheration to pay the loan back and all, because anyway, they will die after some time. So that is a scheme of reverse mortgage. So generally, let us say up to 60% of the value of the residential property will be given as loan. Generally, not that property has a 50 lakhs value and the bank will give 50 lakhs. The bank will bankrupt. So they'll give only 60% of that. Let us say they will disburse 60% of that according to the scheme. If the old people wanted it lump sum, they will take it. Otherwise, better thing is to take in installments, so that monthly they have some support in the form of installments. They are receiving. Normally for a mortgage loan, we pay installments to bank. In this case, bank will give installments to us. That is why it is called reverse mortgage. So the loan will be given up to, let us say, 60% of the value of the residential property, and also the bank or housing finance company would undertake a revaluation once every 5 years. Of course, that is their headache. They do that. And bank will recover the loan. Okay, now think about the bank also. Bank is doing social service or what? No, it will not. It is a commercial entity. So it has to recover the loan definitely along with the accumulated interest. It has to. But how it will do? How it will do? Are they going to ask these old people after they become much older? Let us say somebody taken a loan at the age of 65, and even with their good health and excellent whatever the care they take about themselves, they continue to live for another 20 years, let us say 85 years, 90 years. They are okay. They are there staying in the same house. Bank is disbursing installments. When the bank will get the money back? They will not get the money back until these persons die. After the death of the borrower, only the bank can recover the money. That is the problem for the bank. That is why they don't give 100% of the value of the loan, of the property as loan. They keep some amount as their security also. And the amount that they disburse will be inclusive of interest only. They are not going to give only the principal amount. They will calculate all those things according to their understanding. But the point is, how the bank will recover the loan? They will not recover from these old people. No. They will recover the loan along with accumulated interest by selling the house after the death of the borrower. So once the borrowers have died, then they will sell this house. Bank will sell the house and they will recover the loan amount along with accumulated interest. Imagine if they recovered any excess amount. So will the bank keep it? How can they keep it? No. The excess amount has to be given to the legal heirs. Naturally, yes. However, even before resorting to the sale of the house, preference will be given to the legal heirs to repay the loan and interest and get the mortgaged property released. So they will not directly, the moment they see the borrower died, they will not go to market and sell that property. They will say, the legal heirs of this old person, boss, this is the loan that the Buddha has taken. Will you repay it and take this house? You repay it, no problem. You pay the loan and interest and take this house. Then the mortgage property will be released in the name of legal heirs. If they opt so, they say that no, Baba, we don't have that much capacity. Then okay, no problem. Bank will sell that property, and if any surplus is there, that surplus will be given to the legal heirs. This is the scheme of reverse mortgage. And basically, wherever generally the old people are not much taken care of by their children, that's a big problem at a social level. After a particular age, the children not taking care of their parents, and most of the children, even in the middle class and upper middle class families in India, are having their children abroad. And some of the people from abroad, they at least financially take care of their parents by sending money and supporting them. But some of the children don't do that also. So what is the recourse for many senior citizens who cannot work at that age and who don't have any pension? Very few government employees only will get pension in this country. What about all the others? Imagine somebody has done business throughout his life, worked hard day and night, and after reaching certain age, what kind of social security that person has in this country? Nothing, actually speaking. So at least, if not security given by the government, government is giving a scheme of reverse mortgage through banks. Baba, you have your own house now, use that. Don't have attachment to that house. After you die, anyway, that house will be there only, you will not be there. So what is that attachment? You live there, no problem. Nobody is asking you to vacate that house. But once you are gone from this world, after that, what happens, you don't worry. That is none of your business. If your kith and kin pay the money and release that house, then fine. They can get your house. Then maybe your soul also will be happy seeing them in your house. If not also, don't worry about it. Bank will sell that property, and any excess amount, if at all, over and above the money that you have taken and your interest, that will be given to your legal heirs. This is the scheme that is given to senior citizens. Is the scheme basically. That is reverse mortgage story. For understanding all this, you need to understand the story first. Now, what is the provision? This is all story only. There is no provision in this. What is the provision? Provision is this. According to section 47, whatever this 16, transfer of capital asset in a transaction of reverse mortgage is not a transfer. We know that section 47 has all the transactions which are not regarded as transfer. This is one of them. We just know the name then. Now we are knowing what it is. So this old guy has given his house to the bank. Is it a transfer? He received, let us say, some lump sum amount only. 50 lakhs worth of house he has given, and let us say he received 30 lakhs one shot. The old guy. Fine. That is not a transfer, first of all. That is not at all a transfer. So that is not possible to be considered as a transfer according to 47:16. And not only that, even 1043, as we were discussing just here, 1043, amount received in a transaction of reverse mortgage. If it is not a lump sum amount also, whatever the monthly amount also that the person, the old guy is receiving, whether it is lump sum or installments, any amount received by the senior citizen in a transaction of reverse mortgage would be exempt from tax. So, no capital gain, no any other source, nothing is taxable in the hands of that senior citizen. So reverse mortgage for the senior citizen is completely exempt. When he transfers his property in the form of reverse mortgage also, it is not a transfer. Even when he receives money from the bank also, whatever the form it may be, whether it is installments or lump sum, that is also not taxable because it is exempt under section 1043. This can be asked as a theory question. What do you understand by a transaction of reverse mortgage and what are the tax provisions related to that? Very popular, possible theory question. You don't need to write the story the way I told you, but you have to write according to what it is there on paper. You need to briefly explain what is this reverse mortgage first of all. Then that is not enough, story is not enough, the provision you have to write clearly. The subsections, whether you remember or not, section 47 says it is not a transfer, and for 1043 says income money received from the bank in the transaction of reverse mortgage by a senior citizen is not taxable at all because it is not income. First of all, it is a loan, actually speaking. So it doesn't have the nature of income also. Hence it is exempt from tax under 1043. That is about reverse mortgage. Now let us move on to another story. Unfortunately, it has become a pathetic story nowadays, but still we are not going to change that. No, not in our hands. But the story is this. The state of Andhra Pradesh, which was formed separately in the year 2014, after being separated from the state of Telangana. Earlier it was a united Andhra Pradesh, and then two states of Telangana and Andhra Pradesh are formed. And Telangana naturally had the capital of Hyderabad. So, especially there was no need for a new capital, but Andhra Pradesh being a state not having any special capital by itself, it was having a scheme of or a plan of developing or building a capital called Amravati, somewhere between the two cities of Vijayawada and Guntur. This was the story of capital of Andhra Pradesh. Name was not given in this, but capital of Andhra Pradesh was given, whatever the capital city may be. But yes, as per Andhra Pradesh government land pooling scheme. So what the Andhra Pradesh government then did was they have collected the land from farmers in the land pooling scheme. It is a kind of development agreement only, just similar to 45(5)(a), but not exactly same, but very similar to that. Only difference is here the developer is who? The government itself. The government of Andhra Pradesh itself has taken the land from the farmers, and what it has promised is they have promised compensation in the form of reconstituted plot or land is provided to the landowners later once it is developed. So agricultural land or some other barren land is taken now, and after some time, once the development of all that area happens, then some plot of land will be given back to the farmers. First of all, is it a transfer? Question comes. Basically, it should not be. Why? Because now only it has happened, just agreement only, and the farmer has just signed an agreement that he is giving his land and he might get land in future. He did not receive 1 rupee also from this transaction. So ideally it should not be transferred, it should not be taxable. That is why exemption is granted under section 1037A. They did not include in 47 separately, rather they gave an exemption under section 1037A. It's a different story. This is not actually correct also, but still we can't help it. That is how the provision has been introduced. Debatable, but lot of people ignored this. Why this could not be included in 47? Why can't it be? If it was included there, it would not be even a transfer. Then everything will be exempt. But no, instead of that, they have chosen 37A under section 10. So what they said is the capital gain is exempt from the assessment year 2015-16 if the following conditions are satisfied. What kind of capital gains are exempt? We'll see that. First of all, conditions are these things. Taxpayer should be an individual or HUF, naturally, and he is owning the land or building or both on June 2nd, 2014. June 2nd, 2014 is technically legally called as the appointed day. So that is the date officially on which date the state of Andhra Pradesh and Telangana were separately formed. So this land which has been now taken by the government in the land pooling scheme. See, usually the governments earlier used to take compulsory acquisition. In case of compulsory acquisition, government gives money to the farmers or whoever the person from whom they have taken the land. So that was normal compulsory acquisition for which sufficient provisions are already there in the chapter of capital gains. But this is a new scheme, variety scheme, which was introduced by the then government of Andhra Pradesh, led by Chandrababu Naidu those days. They have done this land pooling, and the person who was owning a land or building or both on June 2nd, 2014 can give up their land in this land pooling scheme, and in return what they might get is a developed, reconstituted plot or land, which comes later after the development of the capital region happened or happens. So that is the condition number 2, that the person should own land or building or both on June 2nd, 2014. So those people after June 2nd, 2014 purchased for real estate business and all, for them this exemption is not applicable, naturally. And the above land is transferred under this scheme called as Andhra Pradesh Capital City Land Pooling Scheme 2015. So that is the third condition. And if these conditions are satisfied, the following capital gains are exempt from income tax. So what are the things which are exempt? What kind of things are exempt? First and foremost thing, the transfer of capital asset itself is exempt. The transfer of capital asset, which is originally the land or building, which was given up by that farmer, let us say, under the land pooling scheme, that transfer itself is exempt. It is exempt from tax, but it is still transfer. It's okay. Ultimately, the result is same. But if it was not even a transfer, then the exemption is not required separately. If this is an exemption, then suddenly if tomorrow this exemption can be just removed. We gave an exemption. Exemption looks like what? Exemption looks like we are doing a favor to you. The government, idea-wise, let us say, if any of these things they are giving as exemption, means they are doing a favor to the SSC, as if dividend is exempt. Okay, they're telling that, okay, we are exempting dividend up to 10 lakhs rupees. So that exemption itself, as if it looks like it is a favor to the people. But if the reality is here, the people who gave up their lands did a favor to the state government. Any government is government. So they gave up the land, and that you are saying that, okay, no problem. Whatever that transfer you made, it is exempt. Enjoy. First of all, why should they transfer? They transferred with their will, and it was not something that they wanted to get immediately some capital gains out of that. So all these things, from the political point of view, the original scenario there when the transfers and land pooling happened, those people don't understand whether it is important to have it under section 47 or whether it is important to have it under section 1037A. Ultimately, they are happy, thinking that exemption is granted. Great celebrations happened. It's a different story. There is nothing to celebrate in this, because you are the one who, in the first place, gave up your land for nothing. And for nothing, if somebody is giving exemption, nothing of nothing also is zero. So actually you didn't get any benefit. Fine, exemption is there for the original transfer. Not only that, actually, not only that. Even the sale of the land pooling ownership certificate issued under the above land pooling scheme shall be also exempt. This is where people were happy. Yes, because these things they sold, the land pooling ownership certificates, with which they will get in future the land, that reconstituted plot, So these land pooling ownership certificates also, if they are transferred, that means sold, that amount is also exempt. So they got, lot of farmers sold the land pooling certificates at a huge amounts. Huge amounts they received. That is the reality. And all that income was exempt. For that they were happy because a lot of money received and nothing is taxable. They don't understand in the first place, if it was not land pooling, if it was compulsory acquisition, even though it was a urban agricultural land, which it was, since it is definitely within 8 kilometers from the radius of the Vijayawada and Guntur, both sides, 37 already was there. Section 1037 already says capital gains arising from compulsory acquisition of agricultural land is already exempt. So what is the great benefit they got here is separately exemption is granted for selling these land pooling certificates. So even if this land pooling did not happen, without this variety scheme of land pooling under normal circumstances, if the government had taken these lands under compulsory acquisition, which it has right to do, then the compensation, whatever they receive in lakhs or crores or whatever it is, it would have been anyway exempt. So there is nothing special to be partying about this exemption. But still, because of political reasons, a lot of people got excited with this grant of exemption without really understanding there is nothing special about it. It is their basic right. Government framed a new scheme. They did not ask for a new scheme. Government framed new rules. Government wanted new capital. And they were asked to give their lands. And for that, the great benefit that government is showing as if they are giving is, oh, see, your capital gains is exempt. Because it was exempt anyway under 1037. If you took from me from compulsory acquisition, you should have given me hard cash. You should have given me, but you did not give that. You promised me to give some reconstituted plot, and before that promise is fulfilled, you gave me some piece of paper called as land pooling ownership certificate. And now you are telling that if you sell this land pooling ownership certificate, whatever the income that you get is exempt, and you want me to be happy. Okay, that's fine. The farmers were happy with this exemption. Then another point, last point. Okay, some people would have sold these land pooling certificates and some people would have held them, and after owning for a few years, what they will get, what were they promised? They were promised a reconstituted plot, that is developed plot from the state government. They got it. And if they sell that reconstituted plot or land within 2 years from the end of the financial year in which such a possession of that plot of land was handed over, possession, not just the documents, possession of that plot was handed over to the said person, if that reconstituted plot was sold within 2 years from the end of the year in which possession of that plot has been given to that person, then also exemption is there for such sale of developed plot. That is another exemption, and definitely this is where particularly the unfairness begins. This is only a comment from a logical point of view. This has nothing to do with the provision itself. Provision is provision, we can't help it, we can't change it. And a lot of people actually bragged about their achievement of, this provision has been achieved in the parliament. We fought for it and we got it, like that they are telling. I don't know for what reasons, when already then 1037 is there, which was supposed to be anyway exempt. What extra these farmers got in the form of 1037A because of the scheme framed by the government. They did not ask for it. If you asked for compulsory acquisition, maybe they would have given, and even they don't have right to actually say no. Compulsory acquisition itself means what? The kabja of government. That is official kabja, legal kabja, that the government can do. It is the right of the government to take land from any of these people. At the maximum, they can go to court asking for extra compensation. They cannot say no. The right to property in our country is not absolute. Government has the right to take our property anytime. A lot of people don't know that. They think the property is absolute right. So government, if it really wanted to take this property and construct a capital there, they could have done that just like that by paying compensation. But they don't have money. They didn't have money. So what they did? some whatever so-called intelligent scheme of land pooling they made. Ultimately, not paying any money to the farmers, giving them one land pooling ownership certificate in the meantime, and then later, once the development happens, reconstituted plot will be given to those farmers. And what the farmers will do with that? Maybe they can continue to live there, or they can sell that developed plot and get lost from there. But what was the idea here for only 2 years? That is where my objection is. Why this 2 years is mentioned? This should be given forever, no? Because there should not be any capital gain from this entire transaction to that farmer. He has given up his land and he got some piece of land in lieu of that. And you are telling that that piece of land, the reconstituted plot, he has to sell within 2 years to claim exemption. After 2 years, if he sells, that means that amount will be taxable. How come? That is a very pathetic provision of 2 years. Provision is good. If somebody says, oh, 2 years exemption is given, I would say it should be lifetime exemption. Why 2 years exemption? When 37 is absolute exemption without any conditions. When why this has conditions? That you have to sell this reconstituted plot within 2 years only to claim this exemption. After 2 years, they have to pay capital gains tax. Already 2 years has passed. In future, let us say the farmers in that region sell those plots and income tax notices come to them, the situation will be chaos. That nobody probably understood that or cared about it in the past. We have to wait for the future. Of course, the future of that region itself, capital region itself, is in a little bit of question mark. So keeping that apart, even from a tax point of view, very unfair to the persons who gave up this land, saying that you get this plot of land which is reconstituted plot and you have to sell it within 2 years from the end of the financial year when you got the possession of the plot, then only you can claim exemption. After 2 years, if you sell that, no exemption, means you have to pay capital gains tax later. For what? For giving up agricultural land and for taking developed plot and living there. Let us say somebody has constructed a house there in this reconstituted plot. So after some time, if he sells that house, that will be taxable automatically because he has sold it after 2 years. So what is the inherent intention here, which is not there visible, but we have to read between the lines. If you read between the lines, inherent intention is all these farmers or whoever these poor people should not be there in that region within 2 years. Within 2 years, you sell them and make money and get lost. After that, it will be Singapore or it will be Hong Kong or something like that. Dubai, it will become. Is the idea. Nothing happens. It's a different story. So within 2 years, they have to sell off and go. Then only they get exemption. After 2 years, if they sell, they cannot get exemption. Unfair. But yes, that is the provision of 1037A. So if a farmer or whoever, farmer I am just referring to because most of the people are farmers there. Not that everybody is a farmer. Whether land or building is given up by an individual or a HUF towards the land pooling scheme of the Andhra Pradesh government for the development of capital city, and in lieu of that land or building that is given up, initially land pooling certificate is given, ownership certificate is given, that transaction is not a transfer. In other words, it is exempt. It should not have been actually a transfer, but it is a transfer, but it is not taxable, it is exempt. And that land pooling certificate also, if it is sold, then also it is not taxable, it is also exempt. But once the possession of the reconstituted plot is taken by this individual or HUF, then within 2 years, if that reconstituted plot is sold, then capital gains arising from them will be exempt, otherwise they become taxable later. That is section 1037A. Special situation, because it is a recent one, maybe it can be asked, but I doubt it also, because normally the people from other states, why they should be interested in this also. It is a very particular thing related to a particular state and a particular area. So what is the interest in that? What is the big deal about it? Generally, there is nothing about it. But yes, from a fairness point of view, this section definitely did not do justice to the people who have agreed to contribute to this land pooling scheme. That is also not a problem. But on the contrary, a lot of politicians started bragging that they have achieved this section. That is the other big comedy of it. Actually, it is their right, and there is nothing special that 1037A is giving in addition to 1037. But still, a lot of people have mentioned in their speeches that, see, we have made an exemption to capital gains. But nobody told so far the farmers that this exemption is only up to 2 years after you take the reconstituted plot. A lot of people don't know that. Once they know that, they will really understand the problem with this section. Everything else is good except that 2 years thing. If that 2 years thing is taken out, this section is justifiable. And second thing is, nobody can say that they have done a great job in achieving this section in the parliament, because the farmers have given up their land and they would have got exemption under section 1037 anyway. But just because 1037A is introduced, especially they are not getting any additional benefit. That is the understanding of this section, but you should not write all this in an exam. You have to just write the provision and what is the applicability of this provision in the case of land that is given up or building that is given up in the land pooling scheme of Andhra Pradesh Capital City Development. That's it. That is about various exemptions and some of the things which are related to the exemptions, like reverse mortgage and land pooling thing. With that, we can conclude this session, and we'll discuss something else in other sessions. Till then, take care. Bye bye. Thank you very much.